someone returns your money 10x, I'm not saying that happens a lot. That doesn't really happen at all. But if someone does that, let's just say, you don't mind paying them 2% a year and paying them another 20% at the end. You just don't mind that. Versus someone else that will return your money 2x over 10 years. Value is value. You pay for what you get.
Thank you so much for tuning into Journey with Christian D. Evans podcast. My name is Christian D. Evans, your host, and I'm very excited about having this next guest on. This next individual is the CIO and partner at Interplay, which is a venture capital firm. They focus on an ecosystem where ideas scale. They invest and co-found and incubate companies, just incredible companies. They've also have like about 27 fund investments. And just to share with you a little bit about their VC background, they've actually deployed capital in roughly about 53 companies. Some of the companies you may or may not be familiar with, like Benny, Boom and Bucket, Broadloom, Burrow, and so forth. Now, this individual, this next guest, he's been partnered with Morgan Stanley. He was a VP. He was in the note trading side of things, and then he went into the family office in the venture capital world. And we're very excited about having him on because we're going to talk about a lot of the VC investing thesis, a lot of different things that are going on at a macro and a micro level, how to look at it, how to navigate this properly, but also direct deals and how they actually structure their deals to make sure that they're optimizing the biggest and best returns. Please welcome my next guest, the partner and CIO of Family Office Interplay, the one and only Chris Zhang. How you doing today, Chris?
I'm doing great. That was quite an intro, Christian. Thank you so much for that.
Well, man, I'm excited about diving into this. And like I mentioned, obviously, you've got incredible background. You started in Morgan Stanley, you had an internship, and then you obviously, ranked all the way up to VP. And before you obviously were, working with the family office you are now. And I want to kind of dive back into that younger Chris, when you were working on the, notes, credit trading. What did you learn from Morgan Stanley that helped you into the evolution of Interplay and the alternative investing in the VC world, man?
That's a good question. But before I even delve into that, let me just explain a few things. Number one, there are a lot of VPs at Morgan Stanley, so I'm definitely not special in that way. And yeah, over the years, there's a lot of churn and things like that. And also at Interplay, I'm one of 6 partners here, and I run the family office division. And our venture side is separate, and there's actually a Chinese wall between the two sides for obvious reasons, regulatory. So, but I'm happy to speak on what I can speak on, which is sort of private investing, as you mentioned, alternative assets. But now going back to your question, which I think is really good, I came from the public market entirely. As you mentioned, I started first in credit trading. So, for folks don't maybe not familiar with the space, that's, if you see corporate bonds, sovereign bonds like treasuries, are a little bit more complex than that. The second, the derivative of that. So that's called credit default swap, CDS. So these are the instruments that I personally traded in my book. And this was back in Hong Kong at the time. I was trading for Morgan Stanley Hong Kong. And I was covering non-China Asia credits. So Malaysia, Singapore, Thailand, India, those would be the countries that I cover across corporate and sovereign credits. Later on, I joined the rates team in New York, also with Morgan Stanley, and I started trading structured derivatives under rates, and then eventually settle in a role sort of managing the structured notes book. So after all said and done, I would say that the one thing I definitely learned, sort of being an insider, if you will, of the sell side and sort of looking at these complex derivatives and vanilla and sort of all sorts of different products in structured finance, is that it's very difficult. It's very, very difficult, more difficult than people probably think, to generate any alpha. And alpha, I'll define it simply here, which is sort of any excess return in addition to your diversified benchmark or whatever asset that might be. It's very difficult for a few reasons, but the most important one being information symmetry. In public markets, you would hope, obviously this doesn't apply to every single security, but for the majority of the securities that's actually traded and listed, it's relatively transparent. The information you have access to, every investor has access to, whether you are retail or an institutional player, is generally on an equal footing. So you have, you get into company's balance sheet, you can talk to the CIOs, the allocators within the company, the treasurers, and they're obligated to share information, whatever is publicly shareable. So with a level playing field like that, to generate more return consistently over time compared to every other player requires not just immense skill, which is a given, but also a lot of luck. So you're not really picking stock or picking a bond based on fundamentals anymore, because that's a commodity. Everyone can do that. You're really just competing on timing and competing on maybe a small edge in information that you think, or analysis that other people might not have. And a lot of it is just luck, to be frank. So, you see all these very smart folks and smart companies spending billions trying to get an edge, and ultimately, over time, sort of yield a result back to investors that's basically on par with the benchmark. That you got to ask yourself, why are you doing this? What's the point of doing all of this? That was, among many takeaways, let's just say, that was sort of my biggest realization. So when I had the chance to sort of come to the dark side, or the more exciting side, in my opinion, which is the private asset side, I immediately took it, because I realized that this is where information asymmetry, where the level playing field doesn't actually exist. As much as people believe it to be the case that it does exist, and as much as the regulators try, it has not happened yet. And I don't believe it will happen for many different reasons, at least for a while. And this is where you can actually consistently generate alpha, I believe, over a long period of time, as long as you have what we consider a structural advantage, right? Either your firm is set up a certain way, your investment thesis is set up in a certain way, you see the trend, you see the sort of the market dynamic ahead of everyone else in private markets, or simply you just have the right access to the right deal flow, the right person. All of that can give you a real structural advantage that creates a barrier for other people to entry and generate the same type of returns that you do, and you can protect it for a very long time. So sorry, that's a long-winded answer to your question, but I thought that hopefully that clarifies some of your
this is perfect.
questions.
It does. And Chris, it's very interesting that you're mentioning this, because when you are in the private markets and there is this fragmented, incongruencies, there's also opportunities with that. And that's basically what you're saying, because not everybody has access to the information or the relationships or the deal flow that you have access to. So let's just walk right into that a little bit. On your guys' website, interplay.fo, you guys talk about your guys' investing thesis a little bit in regards to your family office. The family office has a broader investment mandate spanning industries, stages, and geographies. The family office invests both in funds and direct opportunities. So I know this is kind of a large question, but let's start 30,000-foot view and then get micro with it. When you're looking at, and I know there's a ton of deal flow that comes across your desk, Chris, and you're the CIO, Chief Investment Officer, before it gets to your desk, it's probably hurdles, it's probably filters. So what is that filter? Yes. What are those things that you're looking at? And you mentioned, from VC to, Series B and onward. So, and pre-IPO companies as well. Yeah. So when you're looking at this, what are those filters that say, okay, hey, this is a good deal versus a bad deal for you guys?
Yeah. Great question again. I'm going to answer it in a different way, maybe, than what you intended to be, but I think it's potentially more enlightening. Let's, again, take a step back, right? And there are broadly two ways that everyone does this. There's a top-down way or a bottom-up way. The bottom-up way of filtering your investments and getting to a what you consider a good investment is you create deal flow, right? You make connections, you establish relationships, you build, you talk to sort of the middleman, right? The brokers and placement agents. You get to know other family offices or investment firms. And once you build that, all these channels of investment pipeline, they come to you. And let's say you look at 1,000 investments come to you each year, and you let all of them go through your team, which of course filters them out based on a preset standards. And you select the best out of the pool of 1,000 investments that come your way. That's one way to do it. And I believe that a lot of people in the market, unfortunately, does have to do it this way. Another way to do it is the top down, which is, this is what, the Union Square Venture, the best of the best, the most disciplined managers and investors do, which is you start from a thesis. The thesis doesn't have to be a particular asset class. It could be a trend. It could just be a sentence. It could be, I think, AI will take over the world in 10 years, right? Something that you believe will happen. It could be very broad. It could be very specific. It's up to you. Once you have that thesis, you then ask the secondary question, which is, okay, if I believe that's the case, and I have a lot of supporting evidence that will show me that way, that I can, convince my fellow investors, then what will be the secondary impact in the asset classes that I want to invest in? This is assuming you're a cross-asset investor, right? If you're investing just in venture space or just in buyouts, different story. But we are a cross-asset investor, at least within private. So we can really look at the whole playing field. So we develop a few areas of focus for the time being. Could be for this year, next 5 years, next 10 years. And then once we decide the asset class or the sub-asset class we want to invest into, we then say, okay, across the entire landscape within this asset class and sub-asset class, what's the best opportunity? Is it a fund? Is it a direct investment? Or is it a combination? So this is the top-down approach, right? And this is the approach that we on a day-to-day aspire to do. It's very difficult because we're not experts in every single asset class. As much as we want to hire the right people and build the right expertise around our investment arm, it's very tough to do that. So a lot of time we have to rely on other people's expertise, maybe external. So it takes time and it takes a lot of effort. But we aspire to be it this way. It's very easy because the easy way out is to say, out of the 1,000 investments, I'm going to pick the best and I'm doing my job. You could be outperforming that way, but that's, to me, a less of a structural advantage over time. So that's that's the one first angle I'm going to answer this. Number two is you also have to consider who you are as a player in the market. For us, we're a generalist, right? We don't specialize in any particular area by design, because there are family offices out there, especially single family offices, that the principal of the family office has a particular operating company that's still in existence in a particular, let's say, real estate or pharma. And the family office can then leverage the expertise of that operating business to invest in similar fields because they know everybody, they know all the players, they know the history, they know what's important. That's not who we are. We're a generalist, and we don't have a lot of principals in the family office. We can leverage their expertise, but we don't consider any of them our focus. If this is your position, and I suspect most of the multifamily offices out there are like this, the number one thing I will say is you do not have a structural advantage by design in direct investments. It makes sense, right? If you're an entrepreneur trying to raise money, let's just use an early stage venture company as an example. If you're an entrepreneur trying to raise money, of course you want to raise as much money as you want at the most attractive valuation. But in my opinion, more importantly than that is you want to make sure that every player on your cap table, especially when you're starting out, is a strategic. Is someone that doesn't just bring capital, but also bring in some sort of expertise, right? Operational help or resources that will help you build your company. Family offices, by definition, especially multifamily offices, like I said, who are generalists, are not strategics. We are simply asset and capital allocators. We bring in money, and that's pretty much it. Of course, Interplay is a little bit different because we do have these service companies and it's a whole ecosystem that we do add some value. But in general, I'm saying for most of multifamilies out there, that is not the case. You're just a partner of capital. That's it. So then, by average selection, if you're a multifamily office, you would not be able to get into the best deals, best direct investments. The best direct investments, entrepreneurs, they're smart enough to know to let in only strategics, at least in the earlier rounds. So this is what I mean by if you're an asset allocator in a multifamily office and you're a generalist, you need to focus your strategy around partners, around finding the right managers of assets, so other funds. So our core thesis, of course, is to start off from there. We find the best possible funds, the best possible partners in each asset class that we like, and then through them is how we invest directly, either through their co-invests or companies that they recommend, might not be even from their fund. And over time, once you build that network, that's how you have your own sort of allocation between funds and directs. And that's how we did it.
So being a generalist then, has that thesis, has that evolved over time? Or have you guys always stated that platform, and then has that become an advantage, you think? Because other individuals, like you mentioned, do get so niche specific. They only focus on AI, technology, et cetera, or maybe enterprise SaaS, et cetera, right? That then they don't see all that other possibility and those other opportunities. So, how has that evolved over? Was that always the baseline of generalist? And then how do you feel like that is an advantage in the marketplace?
We started as a generalist and we are still a generalist. We do not anticipate in any way, shape, or form moving to become a specialist. And we absolutely do view this as an advantage for a few different reasons. Number one is actually this year and last year is a perfect example of that. If you're a VC fund manager, you've had a very tough time last year. Doesn't matter, I don't care who you are. If you've had a tough time not just raising new funds, but you probably had markdowns in your portfolio. Then you had to do a lot of explaining to your LPs, and but because of your focus, because you're a specialist, no matter the market environment, you're stuck in that corner. Part of the advantage of being a generalist or cross asset investor is that we can choose whatever we think that makes sense in the current environment, and that's what we did. So in the new high interest rate environment, this year, our big thesis are private debt, distressed real estate, and small middle market buyouts. Right? You notice that there's no venture in there for a reason. We don't believe the evaluation in early stage has fully adjusted to taking into account what's happening. And we do believe that there's a wave of that's happening, that will happen in the next 6 months. So that's the flexibility that you want as an investor. Number two, and this is really probably the more major point compared to the first point. There's a book that really changed my view of the world and especially in investing. It's called Range by David Epstein. One of the best books I've read in the past decade. In it, David talked a lot about sort of being a specialist versus a generalist, not just in investing, but really across all discipline. And without spoiling everything, I'm just going to say that he made a very convincing case for being a generalist. And part of the reason is that based on his observation, that the real value add in today's world comes from generalists. The best value creation comes from generalists who can take advantage of interdisciplinary, sort of leverage the interdisciplinary, be more imaginative and leverage different disciplines and come up with more ingenious ideas to change the world, right? That's sort of the one sentence summary of what he's arguing. And there's a lot of good supporting evidence for that. So, and that's how I view this as well. I don't need to know, of course, I'm a credit guy, I'm a risk derivative guy, and I now claim to know a little bit about private markets. That's not how I generate value. I guarantee you can find smarter investors, smarter people than me in every single field that I invest into. But how many people are there that can say that they can They know every one of these asset class enough to have a very educated conversation with the best expert in the field and have access to those experts and have access to the best deal flows in these fields and be able to create an asset allocation model based on the current macro environment and based on the correlation of these different asset classes. There are not a lot of us. I can guarantee you that. So that's where the true advantage comes from.
This makes perfect sense. And so what you're basically doing is you're finding those funds, and instead of underwriting those companies individually, right, you're underwriting the team that has proven track record that's able to deploy and allocate that capital, and you obviously infuse capital with them. Now, with that being said, since you're not underwriting underwriting the company itself, right, and all those different portfolio, and as your family office, you're underwriting that team to facilitate those transactions. They have proven track record. So as a family office, in regards to the funds, and you said offline, you deploy mostly 75% of your capital into funds, and then 25% through direct. So with that being said, what are you looking for in regards to operators and funds and the team and things like that? Because like you mentioned, you are starting with macro, you're finding the fund. What does that look like?
Yeah, another great question. So this is really the core of our investing thesis, right, when it comes to funds. And one thing I want to correct what you just said just now, Christian, is track record matters a lot. But by the time, a fund manager has had a 10-year, 15-year track record, chances are you missed the boat as an investor. The fund has become a multi-billion-dollar fund. The team has gone from 2 GPs to now 100 partners. And the returns has invariably suffered from used to be at 20-25% now our fund, now down to a 10-15%. Right? And the logic is very simple there, why that happens. A lot of attrition, a lot of churn, and certain strategies just cannot be applied to a big chunk of capital. I mean, in venture specifically, it's very easy to understand. If you're a $100 million fund and you want to generate a 10x return to your investors, you just need to generate. Let's forget about how many, let's just simplify the math a little bit. Let's forget about how many companies you actually invest in. Let's just say to 10x your fund, as a $100 million fund manager, you need to generate with dilution, sort of as part of the equation, call it $2 billion worth of enterprise value from your portfolios over 12 years period. That's it. So what does that mean in today's world? A couple of unicorns. That's all it takes. The rest you can write them down to zero. For $1 billion fund to 10x your fund, you will need to find a lot more unicorns, and you have to generate 20 billion of enterprise value. Okay, and you compare that to the entire VC landscape, it means that you're gonna have to be in every single deal. This is exactly what happened to Tiger and Sequoia, and I can name 10 other funds that have sort of suffered in the same way. So no, track record is important, but is not the thing that we ultimately look for. We want to capture the best investors of next generation today, right? That's what we're set out to do. We want to invest in small emerging funds, sometimes emerging fund managers that generally are less than 200, 300 million AUM currently, who is hungry, who knows what they're doing, who has a thesis, very disciplined, small team, and has a structural advantage. Those are the people that we want to go out and have a relationship with. And ideally build a relationship over the next 10 years. Become an anchor of their fund, be the first check in or the first few checks in, and have them deliver us the return that's actually promised versus getting into a fund that's 10x, on their 10th vintage, 3 billion AUM. They couldn't care about us because they are focused on the big endowments, who is 30-40% of their fund. So it's a very different game. It's a very different investment thesis.
That's actually, I'm so glad you brought that up because it's very unorthodox and it's really, really a cool approach in regards to, like you mentioned, there's a lot of those individuals that have the big tailwind, but when you finally jump on the bandwagon, that tailwind is kind of, slowing down a little bit. So you want to obviously anticipate that tailwind and kind of move to where the puck is going. So I want to ask you this because I've seen a lot of family offices start, and this is just from personal experience from the people I've talked to, walking away from the management fees from the funds to more of that direct because of all the fees. And like you just mentioned, you're seeing unbeknownst amount of money in the private equity world where they're just sitting on AUM kind of stuff, right? It's just a management fee, and they make a lot of money. They got their lights turned on. Everybody's doing very well, and people are saying there's a misalignment. However, though, you guys are still finding those funds, those opportunities. So I wanted to get your response, how you navigate the fee structure. What is your opinion on that? And do you think that is still fair, or is it more of short term? And the reality is the long term aspect is you can still make a lot of money for the fee structure. I just want to get your opinion and perspective on that.
Yeah. This is another great question. So being where we are, how we position ourselves, and based on everything we talked about, right? And this is yet another reason why it doesn't make sense for us to allocate to, the billion-dollar funds of the world. There are so many of them, because no matter what, we're going to be the small apple in their LP, and we're not going to be on their LPAC. So there's almost no power to negotiate on fees and no leverage whatsoever. If something were to happen, like what happened last week with SVB, look, you forget it. They're not even going to communicate to you, right? They're going to focus on their big LPs to make sure they're okay, while taken care of. You chase them for an email, and it take a week for them to get back to you with a one-liner, right? Being a family office, multifamily office, and by the way, with the intention of creating a diversified portfolio, meaning that you have to be very disciplined on your check size. The only way for you to gain any leverage and control and value add is by being in the more emerging and smaller managers, right? So, and to your point about fees, we don't mind paying for value. If someone returns your money 10x, I'm not saying that happens a lot, that doesn't really happen at all, but if someone does that, let's just say, you don't mind paying them 2% a year and paying them another 20% at the end. You just don't mind that. Versus someone else that will return your money 2x over 10 years. Value is value. You pay for what you get. Fees become a problem if you're talking about these big funds, right? They have a track record of returning 15% a year for the past 20 years. And you add on 2% and you add the 20%, your net return becomes less than the benchmark. And without naming any particular fund, but I can tell you that's the hedge funds, right? Like the hedge funds and the generalist long-short equity hedge funds of the world. That's the story of it over a long period of time. And Warren Buffett famously has argued this point in every one of his investor letter, that hedge funds over time do not add value over benchmark and net of fees. But if it's a fund, again, that can generate you 4, 5, 6, 7x returns over time, fees becomes a bit less relevant, and we don't mind paying for that.
So you put in
especially since we have potentially access to their first close rights and better protections, better terms, leverage to negotiate on fees, and make it more incentive aligned.
That makes perfect sense. So when you're looking at funds, you're not looking at those funds that have that massive, like you just mentioned, you're a small fish in a bigger pond and whatever. So the reality is you find something that you can have control over, and you very articulate not just on the industry and where they're deploying capital in those companies, whether it's B2B SaaS or whether it's technology, AI, whatever, but also it's the fund structure and that underwriting process and the fee structure. That's very, very interesting. I want to pivot now a little bit to the direct. I always find this so fun because there's just so many different ways of structuring the deal and how to operate it and how to do it. Correct me if I'm wrong. Well, let's dive into the direct, thesis. How you guys look at it? What's your process? Again, you guys are very agnostic, industry agnostic, but you guys do focus on, direct deals. What does that look like? What are you looking
Yeah.
for in regards to your methodology and principles, man?
This is hard to capture in a few sentences because it varies by the industry. Obviously, there are a few underlying principles that applies to pretty much all of them. And again, this is my own thesis and sort of represents the Interplay family office only. When it comes to early stage companies, this is especially true, right? By the way, I don't see a ton of value to invest in growth stage at the moment. So we're not really focused on that. A lot of our current direct investments are focused on more earlier stage, because the landscape for IPO and M&A is still not clear, and there's a lot of, let's say, headwinds as opposed to tailwinds in having a liquidity event. So then again, when you ask about sort of the way we think about directs has to also be separated by early stage, late stage, has to be separated by that geography. There's just so many conditions on this. But broadly speaking, I'm of the belief that you can find anyone who's been investing for a little bit and has some knowledge of finance can go out there and identify very interesting trends and even thesis, and can identify, sort of having a rough idea of what could become huge, right? So a lot of people talk about TAM, total addressable market, as a gauge for that, right? If your company is set up to potentially capture a large market share in a big TAM market, then that's the winner, right? But what I would argue on the other side is, at least in my opinion, is more important than that potential upside that everyone can dream about is entry, is the competitive landscape of this particular field. To me, and this is not my idea, right? This is an idea I took straight out of Competition Demystified, which is one of the most amazing books I've read on strategy, but I do believe in it, is out of all these things that you can potentially use to value the intrinsic value of an opportunity, the number one most important is, over time, how can this company defend against potential new entrants? Because if the company is just ultimately the service or the goods that it offers, that produces, is a bit of a commodity, or someone can somewhat easily replicate the same thing with a lot of venture capital funding. If that's the case, because again, think about it, in 2021, everybody with a deck, a 10-page deck, can raise $5 million. Okay, and who says that we're never going to go back to that environment again? People argue, okay, that's zero interest rate, whatever. But the fact of the matter is, if you have somewhat of a track record and you're articulate, you can still raise a lot of money, even in today's environment. So money is no longer a barrier to entry. Okay, it's a commodity at this point. So, but what can you do as a company to establish yourself in your particular field and capture significant market share and protect your margins over time and defend that position against newer entries, people who are potentially smarter than you and are better funded? That is the question I always ask, especially in early stage investing. This is where the structural advantage comes in. If certain firms have just the best structural advantage that's in place, that's not money, that's what makes you sort of think about the potential barrier to entry and their ability to be able to defend their position. And when you establish that confidence, the rest will fall into place. Okay, so they have healthy margin, great. They're going to continue to have healthy margin in the long run. They have growth rate, awesome. That's probably due to the structural advantage. You'll be able to underwrite that growth rate for the longer term, especially when they have more money along the way. Great team, again, that could be defensible over time. But even talent, I will argue, could sometimes become a commodity in today's world, right? Like people always say, there's a shortage for coders, for engineers. But is there? I would always challenge people on that. If you have enough money, are you sure you cannot hire the best person in that field? Right? Again, if assuming money is a commodity, what can you actually not get? That defines what your actual structural advantage is over time, and that can make that's the sort of day and light difference in your return ultimately. Does that answer your question? I hope I clarified.
It does.
I focus on one thing because I do think that's the most important thing.
No, that makes perfect sense, and I'm gonna dive into this a little bit further. So you're talking about the structure of this, and just to reiterate it, so to make myself understanding this, the structure of it, and that includes, of course, the market, what you have established already out of the whole market, whatever that industry that is. Are you guys profitable? Margins? What does that look like? Do you guys also have the team associated? What kind of team do you have? Are they previous founders, et cetera, et cetera?
Yeah.
Is there a lot of tailwind? Do they have a lot of software engineers?
Yeah.
Right? A lot of that, the heavyweights, if you will. That's what you're kind of looking for. Now, I want to ask you this because I'm always curious on this. When you're looking at the industry, and I know this is contextual, do you always like to say, okay, hey, this is a huge market opportunity, and this is like a blue ocean, if you will. Like, this is brand new. This is something like AI is, of course, something sexy right now. A few years ago, obviously, it was something different, and whatever. But my point is do you like to see the larger market? This is $100 billion, $200 billion market opportunity, or do you like to say, okay, hey, this may be very small, relatively, like a $10 billion market opportunity. However, though, we can dominate it and we can own 98% share. Does that make sense? Like, what would you rather have, 1% of $100 billion or 90% of that smaller markets? How do you think about that?
So this is definitely a point of contention because I can tell you that what my other partners might say and versus what I would say, and they're different. I am very much in the camp of the second scenario you mentioned. I believe I'd rather take a $1 billion market opportunity, and we are confident and have strong evidence we have the structural advantage to be able to capture 20% of that, than have it in a $10 billion opportunity set and we can only capture 1%. Because when the moment you realize you can only capture 1%, you got to ask yourself why. Is it because you don't have enough funding, which again is a commodity because other people might be able to raise more than you and they will capture more market share? But more importantly, is it because this is a commodity business? If you're a venture-backed firm and we raise all these tens and $20, $30 million, you can only end up capturing 1%. That's your upside. Chances are it's because it's a commodity service. Other people who can also raise $30 million can also capture another 1% from you. So over time, it's almost guaranteed that your margins will be diluted in a commodity market. So you might be a winner right now. You won't be in the long run, especially when it comes time to exit. So I'd much rather personally have a large chunk of a smaller world where it's actually defensible. And over time, I can use that market share to my advantage to defend against my margins and make myself actually EBITDA positive. I have to stress, this is not a typical venture investor mindset. And I'm not a venture investor. I am a cross-asset investor, and venture just have to be one bucket of what we like to do selectively. But our investment horizon, if you think of venture investment horizon is long, 10, 12 years, ours is even longer. The families that we underwrite their assets for, we take a view of 15, 20, 30 years until their next generation, right? And this is one of our core advantages, which is because of that, and because cash flow is not a concern, we're able to invest in whatever we think makes sense in the longer term that generates the ultimate outcome for our member families, despite the fact that there might be a J-curve effect at the beginning. Yeah.
Okay, gotcha. And so let me ask you this. So when you're looking at a 20, 30-year-old timeline, and I want to start with this first. I would imagine there have been situations where the investment did not work out the way you wanted it to work out. So when it doesn't work out the way, because we've all had experiences like that, even Warren Buffett, right, very well-known investor, he talks about his flaws and what some of the investments and so forth. So it's not really a matter of what that was. It was more of what did you learn from that experience that then helped you obviously get better at it the next time. And then secondly, also, when you're looking at a 20, 30-year-old timeline, how do you make sure, do you like to see like massive growth? Because everything's so just like everybody wants that massive growth, that, just unbelievable 20, 30, 100% growth year over year or whatever. But the reality, or do you, because you're looking at a larger time horizon, you like smaller year over year growth, but it's consistent, and you know that you extrapolate this longer, that you're going to anticipate that. How do you look at that? Both of those questions.
Yeah, well, it's a little bit different, I think, than the way you asked, because when we say 20, 30 years investment horizon, right, we don't, it's actually, what I meant to say is that we can take on the illiquidity risk. And as a result, we expect to be paid the illiquidity premium. And that's the key term here, right? So we won't be expecting that the portfolio that we deploy into today generate income to sustain the expenses of the family in the short term, right? And that's something that we tell everybody on day zero, which is, for this strategy to work, you have to set aside this pool of capital and forget about it, basically. If you're the client, that is. Our team doesn't, because we track it actively, but you just cannot count on it for the short term or even medium term. In the next 5 to 7 years, this is not it for you. After the first cycle, right? So of course we diversify across private debt and buyouts and real estate. So each of these asset classes has a different investment horizon. Could be anywhere between 3 years, 5 years, 7 years, all the way to 12 years. But the duration of your portfolio, in our case, in the newest family that we just onboarded, is right around 7 or 8. Okay, as long as, and we want to make sure. So that's one cycle. That's the average, so-called weighted average, maturity, let's call it, of your overall portfolio. We want to make sure that that number is lower than the cash runway measured in years for that family, right? So after each cycle of investments, let's say we compound the money over time, we capture that illiquidity premium. Within that time period, before that happens, we want to make sure the families themselves do not have to worry at all about cash flow. If all that is satisfied, then we basically deploy it using our unique asset allocation model, which is a liquidity-based volatility asset allocation model, as opposed to your typical volatility-based asset allocation model that's used by hedge funds, endowments, insurance companies, you name it, all the big asset managers. But the key point here is illiquidity premium. So if you can afford that, you got to capture it. If you're someone in a position, or a firm in a position, to be able to capture that illiquidity premium, there's no reason for you to give that up. And that illiquidity premium over the past 10, 15 years, if you just compare it to your private asset benchmark versus your S&P total return benchmark, you can argue that illiquidity premium is roughly worth 4 to 6% in that ballpark, right? So if S&P has returned 12% total return, that is, so that's with dividends reinvested, compounded over time, for the past 10 years, you would expect to at least have 16, 17% of return, measured in IRR, of course, not your CAGR, compounded annual growth, because that's, IRR doesn't take into account the timing involved with capital calls and all that. But IRR to IRR, you're looking at 16, 17%. That should be your benchmark. And if you can somehow capture, you believe you have the access, the deal flow, the pipeline, the relationship to capture the top quartile returns or top decile returns, you should be very close, if not at the 20% benchmark for all your assets together in private assets. Hopefully that explains.
Wow, that does. And so it's more, that makes more sense in regards to the perspective and the way you think about it. It's not that you're holding that asset for 20, 30 years. It is more of that, hey, this is illiquid, and you're obviously having that strategy, and you can anticipate
Yep.
that. And the way you look at the IRR overall, your whole portfolio should be averaging about 20% consistently, which is good. Now, I want to ask a little bit. The first loop back around, and one of the things you learned from an experience where you deploy capital, the business didn't work out the way it didn't work out, and you had to liquidate
Yes.
that, or you exited. Maybe at a loss, but it's better to take a loss, realize loss, but instead of
Yep.
watching it totally go bankrupt. So, what was that process? You don't have to
Yep.
share the example, but what did you learn from it that helped you
Yeah.
obviously solidify your thesis even more so on the front end?
Yeah. The idea of sunk cost matters in every profession, and especially true when it comes to investing. You have to avoid the sunk cost fallacy, right? You have to realize that what's the lost cost, and go in there and just make that logical decision to take a loss, take a hit, and move on. Reinvest that money in something better. The worst thing you can do to your portfolio is to be emotional and hope that something will come back. And this is more true, I would say, more true than in private markets than in public markets. Because of what I talked about at the very beginning of this, that information opacity, right? Like it's easier to hide things in private markets, which also means it's easier if you're lazy to take a back seat and be like, oh, I think everything on paper looks okay. So it takes that extra effort and mental strength to really go in there, be very transparent with yourself, with your own team, with your clients, and be almost brutally honest about what's working out, what's not. And by the way, a lot of times, I'll say this, things that don't work out, completely not your fault. Completely not your fault. Let's just say this whole SVB situation. Companies will go under because of some bank failures. Yes, I know deposits guaranteed, but there's some timing issues involved here. There will be companies that go under because of this. Maybe less pump company now than people maybe initially expected that would go through bankruptcy because of this. But they've done nothing wrong, and you just have to write it off to zero, right? So it's tough, but you have to be on yourself what you can control, what you cannot. But for the ones that you can control, and this is going back to your question, is yes, you even in private markets, and especially nowadays versus a couple of years ago, secondary markets has become a lot more active. Not just for growth stage companies, sometimes even for early stage companies. And not just for directs, but also for funds, right? Secondary LP positions. There are always ways for you to recover some of your capital. There is very minimal reason, that there are few reasons I can think of, besides being just ultimately very lazy, that you should lose all money in your investment. There's always some recovery value you can retrieve. And just move on and learn from your mistake and be very brutally honest with yourself, whether this happened because something that you didn't see coming, or something that's completely outside of your control, or maybe it's something that you just thought you had a right analysis but it just didn't turn out right because of whatever market condition or people churn and things like that. It's just very difficult to predict. And and if it's something that you can change, you could have done better. Obviously, keep that in mind and make it very known within this is my recommendation to anyone who's a CIO and asset manager is, if you make a mistake, make it as public as possible. Don't hide it, just make it, like, admit it, of course, and eat it, and make it so, like, announce it to your team. This is what we did wrong. This is what we could do better. This is my fault or your fault, and go from there. Because that way, it establish credibility. It makes people know that you're human. You can make mistakes, and by the way, you don't need to be right 100% of the time to generate 20% in return for your clients. You just need to be more right than wrong to get there. And this is true for any asset class that you invest into. But
well said,
yeah, definitely a fair question, and it takes a lot of work.
Well said, and I appreciate you kind of sharing that, because you're exactly right. And I always love to talk about the ugly things in life, because not every, in fact, more often than not, those investments that we do deploy capital, you have to take it to the chin, and it hurts. It's difficult, but it's like learning from it. And so I appreciate you kind of sharing your thesis and the psychological thing that it does happen, but also how you obviously pivot. But there's always ways to pivot and still get something, at least 40, 30 cents on the dollar, than zero. And so I appreciate you explaining that a little bit. Chris, I really appreciate you just being on here and talking about your strategies and the way you think about this, and obviously the paradigm and the perspective and your methodology you guys use to really streamline that whole process, right? Even though the power of the generalist is an advantage, and then how you're able to leverage that in so many different verticals and still obviously be doing very well with your family offices that you connect and collaborate with and those funds. For those that want to reach out, that have a question, that are listening and they say, I want to learn a little bit more and follow you a little bit, Chris, how do they reach out to you and be part of what you got going on, my man?
Yeah, no, appreciate you asking that. We have a website, as you mentioned, interplay.fo, and there's an engage button on there. And we set that up for a reason. So there are multiple ways for anyone to engage. You can engage us as someone who wants to join the family office, someone who wants to propose to us an investment, or a service provider that you think you can find ways to collaborate with us. Go through that, and my entire team is on the outreach list, and we'll take it from there. And of course, we have our own podcast, as we talked about at the beginning of this, and I'm on that every week to talk about have a small segment to talk about macro markets. And if you're interested in my view and my team's view, my other partner's view, feel free to listen to that as well.
Awesome, guys. Those links are in the description. I'll put his LinkedIn. I'll put that website. They got a ton of resources on the website, so make sure you just check that out. And then also the podcast. Totally highly recommend listening to that podcast. It's really good. Chris, again, I really appreciate you being on here. I want to ask one question before I let you go fully. You have done very well. You are young still, and you've got still a lot of life ahead of you, but you've done very well and successful. And I want to ask you this, though. If you think about that young Chris, and naive, just getting on the trading, just getting the financial markets, what were some insecurities did you have to overcome to become the Chris you are now?
I missed the last part of you because you're cut off, but I think I got your question. I would say, as far as insecurity goes, and this is I personally think especially true in the world of investing, is that no one knows more than they actually think they do. Or in fact, let's put it the other way. Everyone thinks they know more than they actually do. And this applies to your boss, applies to the person sitting next to you, applies to someone that seems like the superstar that always gets things right. There's always a lot of uncertainty and unknown. You just, as a young person coming into the field of investing, you just have to believe in your own view and work hard at sort of constructing that thesis of your own. You cannot listen to others and believe that what they say is always true. You have to articulate, you have to convince yourself that something is true. And you have to have that belief in yourself, and you cannot over rely on anybody else. So don't let anybody else tell you that they know better than you, because they don't. That was something that I spent the first 3 to 5 years to help overcome that. And every year I thought I was learning and growing, and my colleagues were, always so far ahead of me until they're not. Until one day I realized, actually, no, you don't really know what you're talking about. At least I know a little bit more than you, I think. And and that's that. When you reach that turn, right? This probably applies to all other industries too. Is when you can really blossom and you can really build something of your own and have a business of your own. Who knows? And don't have to keep listening to other people and listen to what they ask you to do.
Well said, man. Well said. Developing your own self-confidence, self-image is such a high level that you know who you are, you know what you got, and then obviously showing up and being defensible. Really great wisdom and timely wisdom. Guys, that is the CIO, Chief Investment Officer, as well as partner at Family Office at Interplay, my friend, the one and only Chris Zhang. Guys, that is Journey with Christian D. Evans podcast. Until next time, be uncommon if you can.